So welcome back, everybody. My name is Derek Frey. I am the Senior Market Strategist at FOREX Traders Daily. I run my online trading room and my trading mentoring through them right now. And so as usual, my session here is the Monday morning live look at the week ahead. I have my newsletter already written and published on the website, so if you want to go to forextradersdaily.com and read it, you can. I'll go through it here in a little bit briefly as well. As usual, really, the purposes of my sessions are really to just go through and answer whatever questions you guys have. So throw it at me, whatever you got, whatever markets, ideas, rumors, you name it. Hit me, is the bottom line. So don't be shy. All right, so I actually am going to switch over and do the newsletter first. And here's the actual newsletter itself. Okay, so we begin the fall season with a fall in the dollar, as we have in the past, in the past. We are buyers of these dips. While the long-term prospects of the dollar remain grim, in the near to medium term, we are cautiously optimistic. We are looking for at least a dead cat bounce in the dollar near term. So far, we're up over 400 pips for the month in the trading room. So yeah, this is for the subscribers. So the euro, this pair has seen a nice spike above the 46 level. Now this was last week what I was commenting on here, and I wasn't talking about the one that just happened. But we are or have just seen a spike again above 46, looking for rallies to sell into the retest of the 146 area. So basically, yeah, I like being short up here. Cable, same thing. This pair also saw nice spikes above 67. Any spikes near or above 66 could be looked at as a sell area this week. I'm particularly bearish the cable actually of the bunch. We'll see how that goes. Swissy, we've seen this pair gravitate towards parity. While we do expect that level to be breached in time, however, in near term, we are buyers near the 104 handle, below the 104 handle, basically. Dollar yen, this pair has been attempting to decouple from the S&P 500. We are seeing it try and throw off the shackles that have been U.S. equities. We expect this pair to bounce around the 90 to 93 level for the rest of the month, and are therefore buyers near the lower end of that range and sellers near the upper boundary right here at 91 or wherever we just were. I did just take a short at 91.06, but we already covered it at 90.80 something for 25 or something points. I don't know. But the bottom line there is I'd rather be a buyer of a dip more towards 90 than anything on that pair. I think cross that bridge as I get to it. But for now, it seems that we have more upside potential than downside risk. Aussie, this pair continues to hover above the 85 handle. This pair has both strong potential to remain stable due to solid economic policy by the Royal Bank of Australia. I'm patting them on the back, by the way. And at the same time, high risk of a sharp pullback should the dollar strengthen and commodities falter as a result of that strength. So that being said, we want to be extra cautious with this particular pair. But the bottom line is we see more downside risk than upside potential and are therefore selling rallies. And then lastly on the CAD, this pair has been an attractive long below 109, really closer to 108, but somewhere below the 109 handle. We're looking for a move into the low teens before the end of next month. I could almost say before the end of this month, but I don't want to be too ambitious, so I said next month. But definitely looking for a move higher in the dollar Canadian pair in the next few weeks at least. So that's my down and dirty newsletter for the week. It's pretty short and sweet, pretty straightforward, as it always is. Last month we did 1,600 pips. The month before that we did over 1,000. This month we're up, I don't even know. I think it's closer to 500 now, 400 and something. Somewhere between 400 and 500. And, I don't know. This stuff just continues to work. What's happening with the dollar? Well, it seems to be trying to go lower, but, I like to buy things when they go on sale. And it seems to me that the dollar's on sale, relatively speaking. So I'm happy to buy it down here. When trading harmonics, can you put your stop just above or below the reversal candle, or must it be just outside of the PRZ? I usually go a significant distance outside of the PRZ, not just a slight one. I usually go, 10, 20, 30, 50. I've even been known to go 100 points outside of a PRZ. So a significant distance away from wherever the PRC is where I tend to run stops. Now, sometimes it's just not feasible, and then you have a choice to make. You either diminish probability by placing your stop within the PRZ, or you just don't take the trade. There's no right or wrong conclusion within those two choices, but you got to pick one of them, obviously. Which central bank are you more disgusted with? Bank of England? Oh yeah, definitely the U.S. first of all, and then the BOE would be the big two. I would say that we are acting completely irresponsibly, and the BOE is acting shamefully because they're not doing anything except for following along with what we do, which is stupid because we don't know what we're doing. So, and I mean that literally and figuratively. So, I think you're kind of picking amongst losers there. It doesn't really matter, who's worse. So what else you guys got on your minds? You guys are quiet again today. What's up? Yeah, I'm in a trade. I'm always in something. Even if it's cash. Elaborate on the S&P? What do you mean? Like where I suspect it's going? It's going lower today. We have 71% probability of closing lower than we are now. So we're right now at 1038 roughly, I believe. So we have better than 70% probability that we close below 1038. Do I have a target? No. Yeah, of course, the Dow. If the S&P is going down, so is the Dow. Euro, same story, basically. I'd be short. I think I said that already. What else about the S&P? Oh, yeah, here's the models. So here's 2-minute, 5-minute, and 15-minute. I don't know if I'm displaying this or not. There. 2-minute, 5-minute, 15-minute projection. You can see the energy waves are all projecting down. So if energy is being drained out of the system, it's unlikely that the market's going to be able to go much higher. It's possible, but it ain't probable. Lots of things are possible, but only a few things, or usually only one thing, is most probable. Yeah, I have a daily live trading room. Of course. I have trades. I've made almost 200 points today alone in my trading room. Here's the trades. I'll show you. Made 151, made 34, made 10, lost 21, and then just made, oh, this doesn't show the update. Hang on. Just made, this doesn't count because it's not mine. Just made 23 on the dollar yen. So what's this, 150? Yeah, it's a little over 200 for the day. Anyway, oh, I did get out of that a little early, didn't I? Oopsie doopsie. What else you guys want to look at? Thanks, Rob. I don't do trends. Trends are for losers. The trend is whatever you're not doing. I'm serious. I'm dead serious. That's what the trend is. Whatever you're not doing. I'm dead serious. I'm actually not trying to be funny. Because that's the reality. The trend is ambiguous. It is a meaningless term. It doesn't mean anything. What do you think the trend is? Because I guarantee whatever you think it is, I can prove it's the other. Guaranteed. Somebody. Anybody. Tell me what you think the trend is in any market. I guarantee I can contradict it. And then I guarantee if we go get some other speakers here on FX Street that they can contradict my contradiction. And then I guarantee if we go get other people, they can contradict the contradicted contradiction. And so on, and so on, and so on, and so on. So isn't talk about the trend nothing more than masturbation? Little more than theoretical masturbation? Am I wrong? Really? Somebody tell me, am I wrong? I mean, don't get me wrong, masturbation is great, but I don't really find it useful in trading. You know? I mean... No, trend stuff is a joke to me. I find it useless. So, anyway. But I know a lot of people hear this, they get this saying in their head, the trend is your friend. And for some reason they latch onto that and they think that it's like wisdom or something. Somebody quantify for me how the term the trend is your friend is going to make you money on your next trade. Anyone? You can't do it because it's an undoable thing. The thing to Dre, to sign up for my room, it's right here. The mentoring link is there and the trading room is there. Oops. Yeah, there. I'd rather kick my own mother than trend or even talk about the trend anymore, let alone trend trade. And I love my mom. It's a complete waste of our time. I mean, we can do it, but it is a total waste of our time. You guys want to talk about something meaningful, or you want to talk about the trend? Peter, you're going to be ignored. Piss off. Anybody else can ask a question, though. All right. Trend is your friend until the end. You're rude. Run along. Anyway, so the trend is your friend is a meaningless idea. Sorry. The three different time frames, small, medium, and large. You got to qualify that. I mean, quantify it. How are you going to say? What are you going to say? I mean, what's small, what's medium, and what's large? It's all relative to the individual. To me, a long-term time frame is like an hour or 4 hours. Somebody else, it might be monthly. So it has to be qualified. If you're going to have the conversation, it has to be qualified. And then you also have to qualify it by looking at the time component. Because even if you're both looking at weekly charts, how far back are you looking? One of you may be looking back 10 weeks, another may be looking back 100. Obviously, the trend's going to be different. Most likely going to be different from 10 to 100 look back period. So it's all got to be qualified. That's why I go off on this, because it's when people just use the word ambiguously and they don't qualify and don't understand that, no, that doesn't mean anything. And when people, especially new people that get that silly term in their head, because don't you know that every time that you're in a losing trade, somebody turns around and says, well, the trend is your friend. You were going against the trend. Well, and you're like, but I wasn't. Because you weren't, because you were going with whatever trend you thought it was, but somebody else, it's just like Elliott Wave. Anybody can start their Elliott Wave count anywhere they want, and you get 10 Elliott Wavers, Elliotticians, whatever, in a room, and you're going to get 20 wave counts. That's the old Elliott Wave joke. It's the same thing with trending. You get 10 trend traders in the room, you're going to get 20 different descriptions of the trend. So it's just an exercise in futility, because you're impatient. That's why. What's your question now? Seriously. I'm not a contrarian trader. I'm contrarian to being stupid. I'm contrarian to being an idiot, but I'm not a contrarian trader. By going along with the math perception while it's moving in a certain direction trend. I don't understand. Is that a question? Is going along with mass perception while it's moving in a certain direction a trend? I guess I don't understand what your question is. Is there another one above this that I missed or something too? By what you said, trend in the U.S. is short-term down, long-term up. No? I don't know. What are you defining as in the U.S.? Equities? Dollars? What are we talking about? What the heck is going on here? Oh, okay. Nothing. Well, whatever. I use 1 hour to gauge the trend, then use that bias to go down to a smaller time frame and find my trade. That's cool. Nothing wrong with that. But it's ambiguous, obviously, right? I'm not saying it's good, bad, or indifferent. I mean, it's fine, but I'm just saying it's not like that's the textbook or there is a textbook way to do it, right? Is there a textbook way to trend trade? Does anybody know? And if there is, can somebody tell me what it is? Because I sure as heck don't know. Let me guess. The trend is your friend. Okay, great. That doesn't help. Right? How do we know what the trend is? Like, really know what it is? How can we not have somebody come back and say, well, the trend was you were going against the trend? Can we prevent against that from happening? No. That's my point. It's exactly my point. I'm glad you mentioned look-back periods. What is the minimum look-back period at the daily level? Oh, I don't know. I mean, I'd want to see a few years of data at least. The more the better. You can't have too much data. But on a daily chart, I'd like to see preferably a few years. I don't know, what does MetaTrader do? This is about a year, huh? Not much. I have much longer term historical charts and other software here. Of course, this shows me stuff, but really the longer the better. I mean, there's no other way to say it. You know, the more data you can get for a look back period, the better I think your overall results are going to be, or hopefully at least the more relevant they're going to be. Because hopefully you'll have gone through after enough data periods of, you know, extreme volatility, low volatility, so that you get it tested on all sides. You know what I'm saying? So like here you can go back in different charting things. Like this is one that I use that goes back many years, just going back just to 2000, so it's not even that long. But of course the euro only goes back that far. Like if I pull up something like I don't know, corn. Where's corn? You can see here we've got charts going back to 1970 for corn. So anyway, it's no big deal. But the more the merrier on the data. So what else are you guys looking at? Trend is the behavior of all the investors. Correct me if I'm wrong. I don't know. Sure. I don't look at any of that stuff. I trade on one thing, probability. I'm up 3,500 pips for the summer. Actually, over 4,000 pips now since June 1. So I think I'm going to keep doing what I'm doing. Call me crazy. So, you know, I mean, I'm just, I don't look at these things the way 99% of all the other traders do. I don't care about trends. I don't care about economic news, reports, central banks, other human beings for that matter. I don't care. I really don't know any of that stuff. I don't know anything about economics. I don't care. Don't want to know. It's a complete waste of time to know that garbage. Or I don't know if it's a waste of time, but I know that I don't need to know that stuff to do what I do. And I am a professional trader who's been doing this for 20 years, and I do know economics and all that stuff, but I don't use any of it because I know it doesn't work. That's why I don't use it. The things I don't use are because I have used them, not because I haven't. I don't use any indicators. You can see that on my screen. These may look like indicators, but they are not. Indicators fundamentally approach the market from an incorrect point of view, so therefore I don't waste my time with them either. Not because I haven't wasted my time, because I have, unfortunately, many years and hundreds of thousands of dollars on those methods. I've actually gotten rid of a lot more money than that, trying all these different methods out, until I realized that really the only thing that works for me, I'm not sure about anybody else, I don't care about anybody else, but for me, the only thing that works consistently is probability. That's it. Probability. And it's not the probability of markets that I study. It's the probability of nonlinear systems of all kinds. The markets are circumstantial. So what's my approach? All right, well, let's look at the trades I took today. So these are the trades that I took today. And all I knew when I took every single one of these trades, like what's one I can, what's a good one to show from today? I don't know, let's just look at this yen. All right. All right. I put this trade on at 9:07 this morning. So right after 9 o'clock, I put a short on. I sold at 91.06, and I had a stop at that time at 91.34. So I was running a real tight stop. The dollar yen is the pair that I can run the tightest stops in of any pair that I trade. That and the Swissy, but dollar yen's even more so. So the bottom line here is that within a half an hour or 40 minutes or whatever, but a half hour, I was able to move stops to break even and remove the risk. So you can see that happened here. And then from there, I simply threw a limit in at 83 and I bailed out at 23. Now, what made me take this trade originally? Because I had a harmonic pattern that showed me that I had a bearish structure, that showed me that I had better than 70% probability that the market was going to break down temporarily. I'm not saying what it's going to do longer term, but temporarily it was saying that at that time, and it obviously did, and we capitalized on it and made money. It has nothing to do with my thought about what the dollar yen is doing or what the Japanese are doing or what the central bank of Uncle Joey's third left nipple is doing. I really don't know or care about any of that garbage. I really, really, really don't. I have no idea what's going on in the outside world. I live in a little rubber room here, and I don't care about the outside world. I don't really watch the news. I don't watch financial stuff at all. I don't read financial books anymore. I simply study the nature of nonlinear dynamic systems and then apply that understanding to a nonlinear dynamic system that everybody calls the market. That's it. Nothing more, nothing less. And I do teach it. I do teach a mentorship, and I do run an online trading room every day. Obviously, that's what you're seeing these trades are in. That's the software that delivers the trades. That's what I'm showing you, or was a second ago. So, anyway. All that other stuff is great, and that's, if you really want to trade based on economics and based on all that theory, that's fine. Knock yourself out. But statistically speaking, you've got about a snowball's chance in hell of making money because 98% of you are losing. And of that 98%, 90% of you are attempting to do it one of those ways, through basic economic theory, basic trend theory, or basic breakout theory, which are all fundamentally incorrect and flawed. So knock yourselves out if you want to stay in the 98%. Keep doing what they're doing. It obviously doesn't work. I don't know why people vilify me and call me a contrarian when I just point out the obvious. Duh, 98% of you are losing. Maybe you want to try something else. Just maybe. But yet, I'm the crazy one. I'm the rude one, according to Peter. I'll give you a rude, tough guy. Can you discuss the Hurst exponent? Hurst exponent is a measure of whether your data series has what we mathematically call persistence or anti-persistence. I think he really did leave. He's probably writing a pissed off letter to FX Street right now. Get ready, Maud. I also guarantee he's down. Anyway, I can only help those that want to be helped. I can't help those that don't. Anyway, The Hurst exponent is a measure of what we call persistence or anti-persistence in your data. It's simply a way of understanding whether or not your data is having a good day in terms of memory or a bad day in terms of memory. You ever have a day where you just can't seem to remember anything? You can't remember your own phone number or how to spell your name or simple things? Sometimes the market's like that. Other days it really has a lot of memory and it's really sharp and it's really good. That's all the Hurst exponent tells us. Are you having a good memory day or are you having an Alzheimer's day? What's going on? That's all it is. What is an indicator? An indicator is, well, the way I define it is what people are used to using. You know what I mean? These mathematical tools, supposed mathematical tools that just look backwards. I mean, if you're only looking backwards, then you're not really doing much, are you? How's that working out for the 98%? Because they're only looking backwards. Because they're using data, they're using indicators that only allow them to look backwards. Backwards-looking data or backwards-looking indicators do not make a statement about the forward future the way people think they do. They really just told you what happened. That doesn't necessarily have a bearing on what's going to happen. Not outside, not with it, and not in and of itself. It doesn't. It has to be taken within context of certain things, like the Hurst exponent, for instance. Without that context, it's another meaningless trend conversation. You with me? So I don't use stuff, and I also don't use indicators. An indicator in my world is also something that was created by man. I don't use things that were created by man. I use things that were discovered by man. The Hurst exponent is not something that Hurst invented. It is something that Hurst discovered. He discovered it in the late 1800s, early 1900s when analyzing the flood data of the Nile River. So he discovered it has nothing, absolutely nothing to do with the market. Has to do with nonlinear systems in nature, which is what the market is. So it does have something to do with the market, but it wasn't created for the market. It was created to build dams, if you want to get technical. But it works damn well, if you can pardon the pun. It's pretty funny. Could you spend more words about your method? I guess I kind of am in the course of doing this, so hopefully this is helpful. Going back to the S&P, why do you assume? I don't assume anything. I know it's more probable that it's going to go down. I don't say it's going to go down, but I know it's more probable. There's a difference. I don't have an opinion. I'm not telling you that I think the S&P is going down. I'm telling you that the probability says it's more likely. That's it. It's not my opinion. Don't kill the messenger. I don't know, don't care. But probability states that it's more likely. All right? I never asked, but the account you have now, was it like a small 5K account or what? Which account? I got a bunch. And no, I mean, no. I have one account right now that I just started trading, Ed, to answer your question. And I'm doing this on purpose to prove to you guys, once again, that I'm not blowing sunshine out my rear end. At least not all the time. I have an account that we threw, what did I put in here, 4,700 or something, or 4,800 bucks in it, just the beginning of the month, this month. So I'm trading that right now as a side account, if you will, next to my managed accounts that I'm doing. So I'll let you know how the progress goes with that monthly as it goes. So ask me again ask me in October 1st. Right now it's up 5% already, but I don't want to talk about that yet because it's still early in the month. Is there a book that teaches harmonic patterns? Yeah, Scott wrote a book, Scott Carney, The Harmonic Trader. I mean, it doesn't teach you everything, but it introduces you to the idea. I teach it in my mentoring class. I teach my entire trading method. I give you my trading method, and then and then you use that as a blueprint, as a template, if you will, and you build your own. You can't just use mine. Very few people are going to be able to use mine, and I don't say that from ego. I say that because we're all different people. We all have different belief structures about risk and about money and about all of these things, and we're also trading for different reasons. It's not so as simple as to say that we're all trading to make money. Yeah, we are, obviously, but you know, it's all relative again to what each person is trying to accomplish. I mean, I have multiple managed accounts for multiple levels of aggression. You know, some people want to be very aggressive, so they go into an aggressive account that uses some leverage. Some people want to be very conservative, and they go into an account that gets no leverage. And then there's other ones even from there, in between. So, let's see, Peter. Yeah, I'm not, I don't know. I don't like that. People need to chill. Do you know any? Of course I know better traders than myself. I know many that have different approaches than me. I'm not in any way, shape, or form saying that my approach is the correct one. I know traders that can make money trend trading. I know traders that make money breakout trading. I know traders that make money news trading. I know traders that make money trading every single way that I say not to do. But here's the thing. Statistically speaking, the odds were not in their favor. And they're not in yours either if you choose to go after those methods. That's all. That's fine if that's what you choose to do. Just go into it eyes wide open. Choosing harmonic trading, on the other hand, immediately flips the odds around and puts them in your favor. So for my world, it was a no-brainer. Of course I want to be on the side of the odds. So, you know, from there, I don't really care. IVAR less than 0.5 equals bad memory day? Yeah, that's right. 98% lose in Forex. What is the percentage that lose trading stocks and stock options? It's about 90%. It's anywhere, it fluctuates between 80 and 98%. It doesn't matter. It's the masses. It's the vast, vast majority. More than 3/4. Always. In all markets. Doesn't matter which one you talk about. Do I ever use median lines, Andrew's pitchfork, action, reaction lines? No. What lot sizes do you do? Oh, in that little one, I'm using no more than a 10K lot, so 2-to-1 leverage at the most, you know. It's actually aggressive for me. Well, for anyone, but for me. Do you find Mondays and Fridays to be good days to trade, or do you prefer Tuesday through Thursday? I do prefer Tuesday through Thursday. I don't really like Fridays at all. Mondays are okay. I don't mind Mondays, but I really don't like Fridays. I rarely trade past noon on Fridays, almost never. I trade on Saturdays more often than I trade past noon on Fridays. Okay? My market is open on Saturdays, by the way. I'm not actually kidding. Anyway, how is the COT report today? I haven't even looked at it, to be honest with you. I don't know. You tell me. Is there any extremes in it? Have you looked at it? The Hearst, in respective of its origin, indicate or tell you something? Well, sure. In this purest sense of the word, it's an indicator, I guess, because but I'm talking about an indicator in the traditional sense, the ones that everybody else is using that are preloaded in your software that are looking backwards. Hearst is looking backwards and using that data, but it's using that data to then make a forward projecting statement. It's telling you what is most likely to be, is your data, again, it's not talking about your market. It's not telling you is your market going up and down. It's telling you, is your data going to be persistent or anti-persistent? That's important, as long as you understand what that means. It's really important, actually. It tells you an enormous amount about probability. You notice it's the only thing I have on my chart. Do you run a hedge fund? Well, not in that exact term. The simple answer is no. Sure, to managed account on and offshore, we don't have a desire or need to be structured as a hedge fund in the United States because the rules and regs are so ridiculous that it's not worth it. It's easier to structure the way we are. So, if I wanted a lot more headaches, I'd be a hedge fund. But I'm not. I don't want the headaches, so I'm not. Sure, then that makes it an indicator. I mean, I don't care. Does it matter? Either way. Where are you going with it? What do you think about market profile? What is market profile? I don't know what you mean. It's interesting that some can make X work whilst others cannot. It may be a dead end, but still people find it an interesting dead end like IQ tests. Yeah. Hong Kong. Oh, triple witching? Yeah. Yeah, this Friday especially, I don't really want to be in the market because of triple witching. I'm totally with you there. Triple witching is when options and stock options, commodity options, and just a bunch of basically derivative type of contracts expire, go off the board, or whatever you want to call it. And when that happens, we have... Oh, yeah, that's right. Okay. When that happens, we have usually extreme volatility going into and out of the event itself. So it's just not worth... It's like, you know, when you have these known events that are coming, guys, you know, why people trade around news events boggles the mind. It's one of the most foolish things I've ever seen. But people love to trade around news events. They think that it's like intelligent. Nothing could be further from the truth, okay? Because what sorry, that's not me, by the way. That's somebody else's trades. But anyway, do more people lose money trading stocks or stock options percentage-wise? I don't know. I think more people lose in options than in the stocks themselves because most people foolishly buy those way out of the money lottery ticket options. But that's not really option trading, that's buying lottery tickets. I was a professional, still am, but made my living as a professional option trader for about 10 years. And I never in a million years bought those types of options that most people buy. I would sell them to them, obviously. I was the one selling them those options. But I would rather die than buy them because they have like a statistically nil probability of ever achieving their strike price. But most people that buy options in the beginning, especially, they buy them based on price. They say, oh, I don't want to risk more than $500. So they just buy an option. They just go in the paper and they scroll down the list and they see option, $500, and then they look at the strike price. That is so ignorant. You should be looking at the strike price and only that, and then look at the price. If you can afford it, great. If you can't, move on. You know what I mean? Like, you don't base it on the dollar figure. You base it on the strike price column. But, of course, the masses base it on the dollar column because they're, well, whatever. Short-sighted at best on their good days. So analyze gold for a strangle trade? Sure. I mean, buy $1,000 column put, or buy you can strangle it or straddle it. It doesn't really matter. Buy a 9.75 put and a 9 and a 10.25 call. Either way, it'll be cheaper that way. Slightly lower probability, but it really doesn't matter because it's either going to move big or not at all from here, right? Most likely big in one direction or the other. Unlikely to just sit here at $1,000. Maybe. But there's only about 30% chance of that. There's better than a 66% probability that you'll get a move in one direction or the other. Slightly better than 66. Same thing. If it's an ETF, it's the same thing. If it's a pure ETF, if it's based off of gold, like on a 1-to-1, I mean, I don't know if they're levering it up, then it's different. But if you just get a straight ETF, just straight gold ETF, normal, same thing. Long, short, call and put, similar strike prices, at the money, preferably, or near the money, if not at. And then, of course, you could, sell the outsides too, if you wanted to condor it or butterfly it, depending on what you did. But you could just sell the outsides, right? So let's say you buy a 975 put and a 1025 call. You could turn around and sell a 900 put and a 1100 call against it, or even a 925 put and a 1075 call, and create a 50. But you'd have to look at the premiums and see where your risk to reward ratio is. But if you can get, 2-to-1 on your money or something close to that, then it's a reasonable kind of trade. Selling a 100 call and selling a 95 put for what expiration? The Greeks are just calculated for you. I mean, you don't want to do the math the hard way. I mean, we can if you got a lot of time to burn, but there's no real need. Your software will calculate it all for you usually. Like these are euro, I don't know. Oh, you did gold. That's right, you're talking gold. Let me switch over to gold real quick. October, so when do the OCs expire? Third Friday in October, if they're an ETF? Or do they go on this future schedule? Because if it's a future schedule, then they should expire in like 2 weeks or something. What's your expiration date? 32 days. So that's tight. What are you getting for premium? How much premium are you bringing in? So then your break-even point is 103.45, right? Or 91.55, right? So you need the market to stay basically within 92 and 103 for the next 32 days. So is that 920 and 1,030? Is that the equivalent on that particular ETF? Sorry, it can't be 920. Oh yeah, I guess it could be. Yeah, it would be. Is that what that is? It's not terrible. You got a nickel spread, and you're getting $3 premium, $3.50 premium on a nickel spread. So your risk reward is theoretically, if you cap it out there, could theoretically be 2-to-1 almost, or a little better than 2-to-1. I don't like advising people to be net naked short options like that, especially that tight. So, I mean, you do what you want to do, of course, but that's, writing options naked especially is a very dangerous proposition. I once lost, I told the story about this a few years ago, or a few weeks ago. When Hurricane Katrina came through, I was short unleaded gasoline call options, naked, partially naked, not entirely, but partially naked. And basically I had my shirt off. I didn't have my pants off yet, but I had my shirt off. And I had to make a more than $1 million margin call that day, the next morning after Katrina rolled through. So yeah, I don't suggest being net naked short options. I learned that lesson very hard. Yeah, it would have to be at $4, of course. So you're risking 55 cents. So it's a reasonable trade, but I just, like I said, got to be cautious in being short premium like that. And here's your delta, your Greeks. really, the only two out of all the Greeks that I ever used are, to be real honest, I mean, you can use the other ones a little bit, but the only ones you really use are your delta and your theta. And for you, you want to calculate your theta. For a position like that, the most important thing is, well, both delta and theta. And you want a low number on the delta, the lower the better, and a high number on the theta, the higher the better. Those are the two Greeks that you want to be focused on. Theta is time decay, delta is the relationship between the option and the underlying market. So, yeah, I can wrap up. I got to wrap up here. I'm being asked by FX Street. So, anyway, guys, be safe. Honestly, please consider putting probability on your side, and I urge you to reconsider doing what the masses are doing. It's obviously not working. If you're interested in getting more info or have questions or anything for me, you can email me directly here. That's my work email address. And if there is anybody who wants info about the mesh accounts or trade room that I run or any of the other stuff, mentoring service, just let me know. All right, guys. Thank you, FX Street, once again. And I will see the premium members back here tomorrow afternoon, and I will see the rest of you hopefully back here on Wednesday.